those that don't know myself and my co-host today, Sophie, I am a portfolio landlord since the late 90s. And so I've been buying properties, sometimes buying and selling, sometimes buying for clients. I ended up sourcing properties. I'd set up a sort of sourcing company back in the early 2000s so we could build successful portfolios for others. Don't do that. Please don't ask me to do that now. Built up my own portfolio, sometimes in personal names, sometimes as joint ventures, sometimes with family members, sometimes in limited companies, sometimes within a pension environment. But it's never really been commercial, with probably the one exception. So my personal sort of experience is around buy-to-let, service accommodation, holiday let, that sort of thing. And also we've been running the mortgage brokerage again since about 1996, so pretty much 30 years. And we morphed into focusing on working with landlords over that time when we realized that landlords really wanted somewhere to come to that for that sort of specialist help rather than a generalist brokers. So that's my background. I'll introduce you to Sophie Hurley. And Sophie, if you want to just quickly just run through your CV.
Absolutely. So, hi everyone. I'm Sophie. I'm the co-director here at the Mortgage Home. We've been running the Mortgage Home side by side for 9 years nearly now. So very similar to Richard, I've got a background in portfolio in property as well. I've got a portfolio of properties, all holiday lets that I manage in my spare time. And day to day, I support landlords and help them build their own portfolios. And I do think that knowledge that we've got of having our own portfolios and properties absolutely come into play then when we're supporting people on their journey and what they're looking to do. It's not just about mortgage interest rates and what lenders can do. We have that bigger picture with it. So yeah, if I'm at work, I'm property related, and when I go home, it's all property related as well. So that's me.
We do. We live and breathe it, don't we?
We do.
So we can wear different hats is probably the thing. So we do get it as a landlord. It's great when there's the good times, but we're also we're in the thick of it when there's the sort of downturn and challenges that you guys have as well. So hopefully, there's something to call on, and we can at least empathize as well with you on that. We're going to get straight into the questions now, and by a country mile, the biggest question on everyone's lips is which I'm paraphrasing. It's been asked in various guises. So this is essentially a summary of the main question. So what is the impact of the Iran war on the mortgage market, on rates, product availability, lender policy right now? What's the short-term future prediction? Interesting one, that. And finally, more practically, what can I do as a landlord, developer, investor do to get the best rates right now? So let's backtrack. We don't have to backtrack far, do we? 28th of Feb is when Donald Trump and the Israeli government came together and decided to start this war. 28th of February. It's 3 weeks ago, would you believe? But of course, as soon as that happened, there's been volatility in the markets. Now, specifically, 2 weeks ago, Keir Starmer made an announcement. It was Monday lunchtime 2 weeks ago. And what it was what was the impact on the UK economy so far on from the Iranian war. And within minutes, we were getting emails from lenders pulling products, and it hasn't stopped since. And there's been very little warning about that. And to give you an idea, I mean, roughly speaking, there's somewhere around 8,000 mortgage products out there at any one time to suit different needs. And right now, there's about 1,400 of them that have been pulled and not replaced. Now, should we be panicking? No, I don't think so, because 80% are still out there that we can cover every basis. We can still cover all your needs. I don't think you guys as landlords would notice the difference, and we're still not finding any issues in terms of being able to source suitable mortgages for you. But yeah, 20% of products have probably been pulled and not replaced. Now, is criteria changing? Generally speaking, not. However, what is a byproduct of rates being pulled and then replaced on a very regular basis is the impact on stress tests. So if you're refinancing a buy-to-let property, if you're buying a buy-to-let property, then you'll know that it's the rental income that drives the borrowing. And there's a stress test calculation that uses a certain interest rate, and the rent has got to cover that interest rate by 1.25, 1.5 times, depending on the lender. And of course, if that interest rate's rising, then you're not going to get as much bang for your buck. You're not going to get as much borrowing on those products. So as brokers, we're having to, try and be clever, try and make sure that we get those best rates for you. Maybe we've got to suggest different ways because, for example, if you take a 5-year fix instead of a 2-year fixed, that formula, that calculation is more generous. So there are some little tools in the bag that we can utilize to hopefully still get you the borrowing that you need. But that is definitely having a challenge for us as brokers that clearly then gets passed on to you guys. So what's been the impact on mortgage rates? Well, over the last sort of 3 weeks, if I summarize it in terms of just looking at the 2-year fix and then the 5-year fix, which are really the most common two categories of products that you guys ask for and that we do research on. So 2-year fix have gone up by about 0.6% in the last 3 weeks. 5-year fix slightly smaller, 0.5%. So that's what we're seeing. It's not all happening at once, of course, because it's extremely dynamic, volatile situation. But that's really where we're at compared to, let's say, mid to late February. Interestingly, so let's look back over the last year. Normal product pricing rules have been in place. And what I mean by that is that a 2-year fixed tends to be cheaper than a 5-year fixed because it's easier for the guys who are producing the products to be able to forecast what's likely to happen over the next 2 years. There's a bit more certainty compared to trying to look a further 3 years out for the full 5 years. Gets a bit wobbly. So guess what? They price that in slightly higher risk. So under normal conditions, a 5-year fixed is more expensive than a 2-year. Guess what? It's turned on its head, hasn't it? Because we've got so much unpredictability right now. We're starting to see, and this is more of a prediction, but I reckon this week onwards, we're going to start seeing 5-year fixed deals cheaper than 2-year fixed deals for the very reason that people cannot figure out what's in Trump's head and how this Iran war is going to pan out. However, it is really fast moving. And if we only look back to yesterday, Trump was threatening to bomb oil and electric installations unless the Strait of Hormuz was opened back up. And Iran have responded in like saying, well, we might bomb all the desalination facilities in the Middle East, causing obviously pressure back on Trump and a different thing. So here's the thing. Trump has called this 5-day ceasefire yesterday, saying that talks are going amazingly well with Iran. Obviously, Iran are going, what talks? So, fake news, what's going on? We don't know. But here's the important thing is that, and I said this on a video about a week, 10 days ago, Trump is a lot of things, but he doesn't want his opinion polls ratings to go down. He doesn't want the American people to really suffer for too much for too long and cause a big issue. And I think he's still trying to pull the strings in terms of how the Iran war plays out, and hence causing this ceasefire this week, because the immediate response is that oil has dropped by 10%. I had a look this morning. It was $114 a barrel. It's $100 a barrel already. So the markets are responding positively to how Trump is reacting and responding to this war. Does it mean he's totally in charge? I mean, who knows how it's going to sort of play out. So, and therefore the markets will respond in kind. So as you can see, it's really difficult to make any sort of predictions when literally day by day the Iranian war appears to be flip-flopping around and the markets responding. Sorry. Oh, someone jumping in. So in terms of making any predictions, certainly from where I'm sat, I mean, it's almost impossible. 3 weeks ago, before the war started, the markets in the UK was saying there's likely to be two interest rate drops in 2026 from the Bank of England, and the markets were very benign at that point, or on a downward trend. And I would have expected, and I've been telling clients that mortgage rates are likely to also pass that saving on, and we could see mortgage rates drop by 0.5% in 2026. Fast forward 3 weeks, and we're now talking about 3 rate rises in 2026. So how fast moving is this pace? And like I say, it could change again before the week is out. So predictions, I'm going to leave that to Mystic Meg. So let's get to the practical point. What can you do right now to try and mitigate this a little bit and to try to make sure that you can get the best rates possible? Well, if you are looking to refinance anytime soon and you're already engaged with the broker, what you must do, and you might want to jot this down as a sort of note to yourself, is to get all those docs over to your broker. Make sure that the tax calculations are in, the statements are in, the pay slips are in. If you need anything signing, get that in first, not last, because what we're seeing is that we're sending out research to our clients and they're going, well, that's a great rate. Yes, I'd like to go ahead. And we go, okay, would you send your docs in? It takes 2, 3, 4 days. And guess what? The rates have gone. So it's a complete waste of time. You must reverse that now. If you haven't done already, get every bit of documentation, get your ducks lined up. Then we send the research out because you've got to be acting on it straight away. Our team have been working through, and I mean, hats off to the team. They're working sometimes 7, 8, 9 o'clock at night because the no rates are getting pulled that evening, and we're having to stay late to get applications submitted before the rates are here because it's taken that long to get documentation for clients. So please help us, help yourself, get those docs in immediately so that when we do get the research out to you, then once you make a decision, we can press the button the next day or later on that day. We get little more than 24 to 48 hours notice at best from lenders, and sometimes no notice at all. Sophie, is there anything you think I've missed or you want to just add about clients getting the best rates or anything about what I've just said?
I agree with everything you've said then, and just exactly that. You can't sit on it, but I think the one thing just to add to that is people are nervous to make a decision under high pressure, and I get that. You want to be able to have a thought process on it, go to bed, sleep on it, make a decision in the morning. And obviously, given the circumstances right now, we're telling you that's not possible. But if you say, yeah, go ahead, lock it in, that's exactly it. We're locking it in. If the rates then do rise overnight, you've secured that rate. It does not mean, though, you're stuck with that rate. You're not bound to it. You're not legally obligated to take it. You could change your mind a day later, 3 weeks later, as long as you've not completed, which it's going to go through that process anyway of the underwriting, the assessments, etc. You can walk away, but you have secured it at that lowest deal on that day. The other thing as well is flip side, and I know this is probably not going to happen, and like, there's all this uncertainty, and it's likely that we're going to see more rises before we see anything else. If Trump goes to bed and wakes up the next day and decides to call everything off and things do start, settling down a little and we see any sort of decreases and they say, okay, we didn't need to be as hasty with the increases that we put out in rates, we can switch to those lower deals, but you're protecting yourself by locking that deal in at that point if they then do continue to rise, which, given what's going on, is the likelihood of what's going to happen with rates. So don't be nervous to such a degree about saying yes, go ahead. It doesn't actually mean that it's set in stone, but you've protected yourself.
I think that's a great point, Sophie, that you made about existing mortgages coming towards the end of the deal, and it's a question from one of our guests today on that particular point, that depending on the lender, you can press the button as much as 6 months before the end of your deal. Now, it is getting more unusual to answer the question specifically from one of our delegates on here, that it's moving to the norm is more 90 days before your product ends that you can then lock in a new deal, but sometimes it can be up as far as 6 months away. So as Sophie said, get it locked in now, because if rates continue to rise, you'd be delighted that you've locked them in today in March. However, if we do turn a corner, if the Iran war does come to an end and the rates start to drop back down, then generally speaking, you can ditch that rate because you still haven't started it. If you did it 3 to 6 months ahead of time, you've locked it in, you push it to one side and you wait and see. And we wait and see as brokers. So there's absolutely no downside to taking action now, assuming you can, whether it's depending on your lender, you have to speak to your broker. Is it 30 days? Is it 90 days or is it up to 6 months? Your broker will tell you. And so we put a date in the diary when it's the first day that you could potentially make that decision and act on it now, because you'd be glad you did if for some reason we go to hell in a handcart, as they say.